All right, welcome to my Facebook Live, Instagram Live, and YouTube, all of the above. I'm gonna wait till some people get on for a second and just give it a few minutes to let some people get on to see what I got going on. But for those of you who are joining and wondering what you're joining, I figured I'd do a live. Everybody was kind of asking me about my stocks and how I do it, how to trade. So I wanted to just do a quick stocks and bonds 101. What does it mean? Now, this is definitely not for anybody who is trying to do advanced stocks. If you already know what you're doing, if you're an expert in it, if you think you're an expert, this is definitely not the video for you. This is for somebody who has $250, somebody who has $500, $1,000, or $5,000 and has never been in the market, or maybe they put their first couple of dollars in the market and they just want to know, what am I really looking at? Where am I really putting my money in? So what I'm going to do is just spend a few minutes based upon what I think you should know, and versus what you believe, what I believe, where I believe you should go. Now, that being said, it's going to be up to you to determine all of what you want to do. It's going to be up to you to determine what stocks you're going to buy. I'm going to give you some examples of those stocks. I'm going to give you some examples of what is called bonds, the difference between stocks and bonds. And these are the basics of what they call equity. Just so you know, if at any time you get into the stock market, just know one or two things. You can and will lose money. So that being said, just know that, again, you can and will lose money. And I always say the money you should start out with is money you want to risk. Oh, that is a bad marker. Give me another marker. So money you should start out with is money you want to risk. What does that mean? That means if I put in $200 today and I lose that $200 today because I really didn't know what I was doing, that I'll be able to sleep at night. So if you go to Vegas a lot, you understand. If you go to the casinos a lot, you understand. Because essentially, do not get it confused. The stock market and stocks and bonds is speculation. Stocks are what they call high risk. Bonds are what they call low risk. And I'll explain the basic difference from that. Some of you may have grandparents, parents, or great grandparents that have probably bought treasury bonds back in the day, U.S. bonds back in the day. That's when you're buying debt. So stocks, you're buying ownerships in companies. Bonds, you're essentially lending company money. So without further ado, I'm going to give a couple more seconds to let a few people get on to realize that I'm live, and I'll go into teaching. Just give it about 30 seconds. Hold on for a second. So remember, I am not a official investor of any kind except my money. I only invest my money. When people come to me, my friends and my family, when my friends and my family come to me about buying and selling stocks, I always tell them, I show them how to do it, and but I let them know simply two things in my thought process. And my thought process is simple. If I lose my money, I'm not upset. If you lose my money, I'm upset. So if I give you $10,000 and and you lose my $10,000, we got a problem. If I put $10,000 in the market and it goes down to five, or shoot, the company goes bankrupt, then at that point, yeah, that was a risk I took. I really don't have a problem with that. Now, let me tell you how I got involved in the market, which is important. I got involved in the market really simple. I had saved up some money. It wasn't a whole lot of money, but I knew that I was missing out. I think several years ago, I don't know when it was, but I'm gonna just say maybe 2016, 2014, give or take some of that time. The oil prices was really low, and I was listening to the radio, and I remember I just came into some money, and I was really broke, but I came into some money, and it was just enough that I said, you know what, I want to buy oil stock. I think oil at the time was about $20 a barrel, and gas maybe about a dollar, maybe 185, $2, give or take, something like that. Well, anyway, I wanted to get into the market, and I went into a couple of places, and they told me that they said, well, in order to get into the market, you have to have $10,000 to $25,000, and I wasn't fit to give anybody $10,000 to $25,000 at the time. Wasn't going to happen. And then I give you all my money, and I don't know what's going to happen with that. So what I set out to do was to figure out, how do I get into the market for myself? How do I start off with the market? And one, was I able to start off in the market for without having that much amount of money? So I had an aunt come and tell me. She told me, she says, if you get $1,000, you can get into the market, and that $1,000 has to be money that, one, you're not willing to spend right now, and two, that you're willing to lose. So put aside, however you get that money, however you set aside. So what I would do is I would just set aside a little bit of money. And I always remember what my aunt said. She said, if you get $1,000, then you can do it. So here is what I'm bringing you guys. I don't think you need $1,000, because when she told me that, there were some things that were in place that make it a little bit, that are not in place now. So it makes it a lot easier, where you can essentially start with $0. So we're going to start with the basics. Now, where's my marker? Again, this is not, I'm not an investor. This is just Cordell, the Cordell you see playing on the internet all day, every day. This is me doing what I do. So I just sit around and think about nothing. I do nothing, and I come up with ideas. So you're going to get part of me today. If you have any questions, ask those questions. If you do not have any questions, then just listen. All right? So, two things that needs to happen. Is the battery die? Mm-hmm. Don't worry about it. That's just charge it. It's okay. All right. So, first thing is, a number of people ask me, where do I go to trade? Now, I may use, E-Trade. I like E-Trade just because they provide a lot of tutorials, a lot of resources, things like that. But you may have, free apps called Robinhood. What is it? TD America? TD America or Ameritrade or something like that. If I'm wrong in the name, Google it. Again, I'm not an expert. I'm not a financial expert. I'm just telling you opportunities that are out there. Or any particular trading app of your choosing. And so there's hundreds of them. There are hundreds of them where you can go and you can sign up for a thing, a trade account. What you're looking for is two things. One is a cost per trade. What is the cost per trade? Each one of them are going to have their own cost. And I'll explain what a trade is later. Don't worry about that. But you're going to look for the cost per trade. Everybody's going to have that. They're going to have some type of price. It may range from $0 to $9, $9.99, and anywhere in between. If it goes above that, you're getting ripped off. But most places, because of the free apps that are coming out now, there's enough people out here to go. See, TD Ameritrade. See, that's why you get paid the big bucks portion. But most apps are right now towards $0, and that's really where you want to be, where you want to buy. What that basically does, it says that you can buy and sell for zero commission. And I'll explain what a trade is later and all of that stuff. But it really doesn't matter where you go. So if you Google and find a particular site that's better than others, that offers you more information than others, then that's great. You want to go with somebody who can trust, because if you go from start putting $25 in the market, and then all of a sudden you have $25,000 in the market simply because you keep putting it in over time, or because if you think, or you're putting it over time, or just because you ran across $25,000, you want to be able to access your money, get it out. Some even you'll hear the app called Acorn. Acorn is a good one. It doesn't allow you to trade, but it trades for you. And that's a little app on the phone that allows your change to get traded. But if you understand the concept, you'll know if these people are doing a good job or bad job with your money. So here's the thing, what I'm going to talk about. Again, you can write these down, you can research, just Google a certain number of things. So one is the cost per trade. Two is you have to know what you're trading. So when you start, you're going to look for their cost or minimum deposit on a brokerage account. Now, you're going to look for what the minimum is. Why? We all know that if you can put in $1 million and nobody's going to complain. But if you're going to have a minimum to start your brokerage account. The minimum is, some may say you can start off with a $0 minimum. Remember, this video is for people who are broke, who are trying to get into the market. That means you got $5 you want to start, you got $10, $25, $250, $1,000. That's what this video is for. So we want to find out what is the minimum brokerage account that can get started. And you also want to start doing what is called Roth IRA. Now, essentially a Roth IRA is a fancy name for investment account. It's a retirement account, and I'm not a tax attorney, I'm not a tax accountant or CPA. So if you want to know what they mean, know what they do, or your effect on your taxes and your money, go seek an accountant. Don't look at me. I'm gonna just tell you how to put money in. But most Roth IRAs start with $0 to open up, because it is designed for you to build up over time. In other words, to go from zero to as much money as you can make to the time you hit 65 or 60 something, 62, 65, 60 something, whatever the age of retirement is. That's what it's designed. From now, well, however old you are to the age of 65, 62, 67, Congress will probably change it tomorrow. Who knows? But your age of retirement, you'll be able to start taking some money out. So it's designed to start from zero. Whereas a brokerage account is designed for you to basically start making money now. You can become a day trader and you can have all these different accounts under a brokerage account. You can put your money in today, you can flip it, you can take your money out tomorrow. That's what a brokerage account is. That's when a lot of people buy, sell, trade, day traders get in, get out, or you get a long-term, short-term investments. This is, this is what this is. So look for the minimums. Now, last I know, what did E-Trade charge you to get started?
500.
Okay, $500. So last person that I recommended for E-Trade, it for a brokerage account was $500. Now that's not a lot of money in the trading world, but don't worry about that because some other places may charge less. They may charge $25. What they essentially do is they charge you enough to make sure, one, you're serious, and two, you're actually going to put money into the account and to get the account started. Now, let's go into the details of what stock is and what bonds are, and then we'll kind of go from there. I'll give you guys a second to look at this, to write it down and go from there, just in case you want to think about some things. So I'm gonna give you a few seconds just to write it so everybody can get what they want, just the minimum. All right, so I hope you got it. If you need any of this information, just put it in the comment section. I'll answer it later. Again, I'm only making this video because people are asking me. I got tired of asking and answering the same question. So I figured I'd make a video to show the basics because I got other things to do with my time. If you know me personally, you feel free to call me. I'll give you a lot more bad information. All right. So the first thing is, what is a stock? A stock is just simply what they call an equity, or you'll see when you talk about stocks, bonds, and all these other things, it's called equities. And the reason why they have all these different markets and, millions of ways you can make money in the marketplace, stock market, NASDAQ, Dow Jones, all of these things. So this is equity, just like equity in your home, it's an asset. So essentially, when you have stock, what you have more than anything else is you have ownership. It is your way to buy ownership in a particular company. So when you have ownership in a particular company, this means that for every one stock you buy, that's a percentage of ownership. For example, if company A on the stock market, let me get a live company so it can make sense. Do me a favor. I don't know. It's not opening up. Let's open it up. All right. So if company A has a hold on for a second. I'm gonna get you a live company. All right. I'm gonna take Coca-Cola. Use a real company. So right now, when a company issues a stock, they basically put all of this stock in a potential marketplace for you to buy, sell, trade, whatever the case may be. So at the end of the day, so right now Coca-Cola stock is worth $45.03. That's what it is on the open market right now. Coca-Cola has about, let me see. All right. I don't really see. Okay, yeah. Coca-Cola has, give or take, about 193. What is that? Let me see. No, they don't have. This website doesn't have it. So I'm gonna make up my own number for the purposes of this. Yeah, this website doesn't have it. So so I can keep moving. So let's say Coca-Cola has 23 million stock, right? This would be the number of ownership of the stock. This is their average volume of stock that they translate a day, but right now, this is what the stock is. So if they have 23 million stock, this is the percentage. 100% of the 23 million would be the ownership interest. So if you bought 10 stock of Coca-Cola at $43, you would own 10 of the 23 million, right? So you would own 10 out of the 23 million open stock that Coca-Cola would have. Right now, that would cost you $450 to buy your 10 stock out of the 23 million that Coca-Cola stock has. That is how stock, when you're buying your percentage of ownership, this is what you're essentially buying into. Now, when you buy, sell, trade, the more you buy into Coca-Cola, the more shares of this you have. So if you end up buying 100, then if you end up buying 100 shares, then you're buying 100 shares out of 23 million. That gives you more ownership. Now, obviously, if you're just beginning, you're not owning a major percentage of shares in Coca-Cola stock. But as you start to buy more and more, your ownership starts to increase. Now, to just get in, now that means you get, for every share, you get a vote on Coca-Cola's board of directors, on the company. Anything that they want to introduce to the shareholders is what you get to do as a stockholder. You're essentially buying your ownership into the company. All right. So if you have a specific type of company that you want to work with, for example, I always wanted to work and have a giant media company. Obviously, if you know me for years, I've owned and I still own a media company, AJ Miles Media. I'm plugging that. But if you want to be an owner of a bigger media company that's publicly traded, you don't need to go and get all the equipment and things like that. And you want to reap the benefits of these publicly traded companies. All you have to do is buy shares in that particular company. That's it. And then once you buy shares, you become a owner of that company. The more shares you buy, the more ownership you have. That is simply what stocks are. You're buying ownership in that company. Now, there's two things that you have to worry about. One is short term. Two is long term. These have two implications. One is tax implications, and then two is longevity. Why? Because in a volatile market like today, a company, a stock can go up and down. So I'll just give you an example. We'll take Coca-Cola, using that as our example. Within the last month, Coca-Cola has been high as $47.70. And they've been as low as $43.32. That swing is where you make your profit and loss at. Now, if you're in the short-term market, you care a lot about this. Why? Because you're going to buy for 43, and then you want to, hopefully, if you bought for 43 at the low, and then it went up to $47, you essentially made $4 and what's that? 38 cents. I hope I'm right. Yeah, $4.38 per share. Now, at $4.38 per share, imagine if you would have bought 400 of those. 100 of those. I hope they can see this. You get 4. So, essentially, if you'd have bought 100 stock of Coca-Cola's stock here at $43.32, and you're in the short term, again, the short term, this is important. Long term, this is not as important right now. But the short term, and you sell it at $47, you'd have made $438 if you got in, got out. That's what day traders do, but they try to do it for large amounts of money. Again, if I would put another zero on that, put another zero on this for 1,000, it's easy to say I can put another zero on that. That 43.80 becomes 4,038. Okay? Now, I'm going to clean this board up, let you take a look at it for 2 seconds to kind of get a feel of what I'm talking about. And then what I'm going to do is, after you get a feel of what I'm talking about, I'm going to bring it back home for the beginners. Again, this is a beginner. I just took a live company and just gave you an example. But I'm going to break it down for this simple, brand new company to start what I do. I say don't go with the Coca-Colas of the world. What you want to do is you want to go with the maybe $5 companies. Buy $5 stocks because it allows you to diversify your money. And I'll give you ones that I'm investing in so you know where I put my money in. It doesn't mean that you'll make money. It just means you get to lose money with me. Okay? All right. So take 2 seconds. If you're the type that needs to write it down, I'll give you a chance to write it down, and then I'm going to wipe this off, and then we're going to go to the next thing. I'm going to simplify. We're going to simplify the stocks. Okay? Questions? Any questions?
Longevity.
Long term.
No, short-term long-term, but you said they affect longevity.
Well, I'll get into it. Now, I'm gonna get into the long term shortly, so I didn't forget about this. I just gave you an example of the short term, so I'm gonna do the long term in a minute. All right, so right now, let's say, and here's where the difference between long term and short term comes into play. I just kind of gave you the example with the real world. So day traders trade for the short term. They don't really care about taxes. You got to think of day trading as I'm getting in today. What money can I make today? Like you're like the entrepreneur that goes outside and brings his money home today. The entrepreneur. Hold on, bring this back just a little bit. The entrepreneur that brings his money outside. I'm sorry, makes his money outside, brings his money back today. That's your day trader because you're looking to turn $1,000 into, $2,000 or $3,000 that morning, that day, that week, whatever the case may be. When you're dealing with long term, you're not so much thinking about that. And I'll explain the difference of when, where, and why. And then I'll repeat again, this is for beginners. This is not for sophisticated people. So let's just say you bought a stock. You're looking at some stock to get in. Let's say right now, we're going to take a stock like MRO. So MRO this is a real stock. It's a Marathon Oil. Right now it is at $5.89. I'm going to make that $5.89. I'm going to make it $5 just for the sake of this conversation. It's at $5.89, but I'm going to make it $5. Why? Marathon is an oil company. And, for the most part, they've seen some stability. They've been through oil trials from thick and thin. They're not too big. They're not too small. So in my mind, I purchased Marathon for the purposes of, I think that they'll make it through. I think that they'll make it through why gas prices are so low. For me, this is what was one of my picks. Now, so if I'm going to give you a budget. So if you have, let's say, $500, right? You want to get started. You want to get started in the market. So you have $500 to start off. So I have Marathon Oil. The first thing I want to do, and this is the short term, just to kind of get started. And I'll deal with the long term later. So the first thing you want to do with the short term market is you want to say, I want to spread out my $500 as much as possible. So I'm going to put $100 I'm going to divide that $500 into 5 different stocks. So my first one is MRO. I started with buying any stock that was under $10 because I needed to diversify. I didn't want to put all my eggs in one basket. I don't care how hot somebody tells me something is, I didn't want to lose all my money. So you would pick your different stock. Just pick 5 different stock that you can buy for $100 worth. And if you guys can't see this, just let me know. So you got $100 worth of stock. That means stock 1, stock 2, stock 3, stock 4, stock 5. That way, at any given time, one of these will be going up, one of these will be going down. Every time you log in, this may be gaining money, this may be losing money. We're going to go to another stock, NGL. NGL is another gas stock of mine. And they're at 508. So roughly about the same amount of money. So I buy $100 worth, $100 worth, likewise. Now, what happens with stock is just really simple. It's a rise and fall game. So with Marathon, our beginning stock here, within the last year, it was as high as the high in Marathon was $14.70 a year ago. And the low, what they call a 52-week range, which is within the last year, most stock markets will give you a high and a low of that market. And the low was at $3.02. Right? So if you got in and you put your money, your $100, buying into MRO, knowing its history, and you believe that MRO is going to make some money in the long run, let's say if it was at its low point, if you purchased that $100 worth of stock, what is $100 worth? What's that? Probably 33 stock at a low. Give me a calculator. Is that live? So I'm getting my numbers, even though I'm a math genius. All right, so yeah, I was right. $33. So you're gonna have $100. You get 33 stock. At, turn it down just a little. All right. So if you got it at its low, you'd have got 100. You bought $100 worth of stock to enter the market. Somebody told you this is a good investment to buy, and it was at $3 because they knew at one time they believed. Oh, what was it? So they tell you at one time this was going to go up for whatever they said. This probably is worth, let's just say $10, even though the top was 14. They say I'm thinking this 3 is going to go to $14. So you say, you know what? I don't want to wait a year for everything to come up, but I think I can double this, or even triple it. So you go spend your $100 and you buy $33 worth of stock at $3.02. I'm going to make this 0 just to make this easier. So now you're going to buy them at $3 each. So now at some point, this 3 come here, as I said, I'm sorry. This 3 becomes 5, just over time, maybe within a few days. So now your $100, your 33 stock, is now worth $165. So your $100, this going from $3 to $5, is now worth $165. But let's say the market keeps going up, gas prices keep going up, people are now out driving, Marathon and all of the speculators think the value of the stock is going to go up. So now this 5 eventually turns into 10, right? So now, well, let me put this back. So now your 33 turns into $10, which turns into $333. So, long story short, your $100 investment in $33, $100 investment in 33 stock when it was at $3 is now $33 times 10 is worth $330. So here your 500 has already yielded you 330. That's if you let it go up. And this is potential. It's all speculation. You don't know if it's going to do it. It can stay at 5 for a while. But even if it stayed at 5, that's still 165 that you basically made because this went from $3 from $3 to $5. So even that $2 move at 33 stocks can yield you $65, 65 more dollars. All right. So that is the basics of how stock move. Now, this can happen again to each stock, whatever you have your value at. So you want to spread this out because what happens if it happens the other way? And what do I mean by the other way? What happens is something crazy happens, some war happens in the Middle East, and gas prices just drop. We can't control it. Gas prices drop. So now that $3 becomes $2. So now that $100 goes to $66. You see? And that is what we call market forces. A lot of it we can't control. So a lot of this stuff we can't control. What if it goes? No, I'm just saying in general while you're watching. So a lot of this goes the opposite way. So what if that $33? The $100 now becomes 33. So now your $100 here becomes 33. So you can lose money. So I've shown you the negative, I've shown you the positive. Now, a lot of day traders deal with this. And for the most part, if you get into the market, you'll see the jump go off and on. Now, what I've learned over time is that when you're dealing with a strong company that has strength over time, more often it'll go up than it will go down. Okay? Now, I'm just give you a quick second to kind of write that down, 2 seconds, as the professor does. All right, so while I'm getting rid of this, I still want you guys to pay attention to this because this is going to happen with each one of these stocks. And you have to think of stocks like a grocery store. Just because this is going up and as this is going up and down, this is going up and down on its own. This is going up and down on its own, and likewise. So what I always recommend is your first set of buying stock. The first time you buy stock is go into different markets, meaning gas, maybe travel right now, maybe grocery stores because a lot of people are going out. Shopping more because of the corona and things like that. Maybe even takeout, things like Wendy's or any of those departments. Then other stuff, other what they call commodities. So we'll deal with all of that means later. And if I say anything that you don't understand, write it down or put it in the comment section or Google it. Google is your friend. Now, the other way, so that way, the value of the stock we just learned is how you can make money in the short run. You can make it long run too. You can make it in the long run too, but in the short run it matters more. Why? Because you're putting your money in today. You want your money in. You want your money out today. Now, the next thing you're going to do is called dividends. What does that mean? This is for long run people. All right. Now, dividend is for long run people. Why does it matter? Because remember what we said. If you buy stock, you are a owner or a shareholder. So every company that you buy, that you have stock in, even if it's one stock, you are a owner or shareholder of that company. Now, I don't want everybody to go run up in Coke and say, I own this. It's not how it works. But at the end of the day, and theoretically, if you probably own 10% of Coke, I'm sure that's how it works. You know. But for me and you that probably got one stock in Coca-Cola, nobody cares. But you do get the value of owning that of owning that company, and that is called through dividends. Now, the value that we just went through, you're going to reap that because your ownership value increases. This is why Amazon Bezos is almost worth $1 billion or $1 trillion, or whatever they said he was. It's not because he has that in cash, it's because he has that in value. So every day Amazon stock goes up in value. If he was to sell that asset, it is a potential asset, then he would cash out of whatever the amount of shares he has at the value Amazon stock has. So if he has 1,000,000 shares and his stock is worth $1,000, it's whatever 1,000,000 and 1,000 is. I don't know. 1,000,000. No, I'm just joking. Just joking. But seriously. So that's one thing. That's the value. So value doesn't mean anything. It's like having the value of your house. It means nothing if you don't sell it. Your value is only what you've originally put in, because that's the actual money that you've lost or gained. So remember my $100. If the value went up to, like I said, $300, means nothing if you don't buy or sell. If you only still made $100, you didn't make anything really. It's just $100, because even though the value was at 300 earlier, if you didn't sell it, all you had was 100. But if you sell it like the day traders do, then they've made $200. You've made nothing. But how do you make money in the long run? Through this process called the dividend. Now, the dividend is how most people in the long run make their money and keep their money. Because over time, like with your 401k, what happens is you continue to buy and sell or buy into that stock. So let's just take the $5 stock. So if you look at any $5 stock, no, I'm sorry. I won't take a $5 stock because most $5 stocks don't have dividends. But if you ever look at, and if you go visit any stock, in the corner of that stock, it'll have a dividend price. So what is a dividend? So let's take our $5 stock. I said I wasn't going to take it, but I changed my mind. So let's take our $5 stock. If you go look at Google any stock that you like of your choice, it'll either have a dividend yield or a dividend payout, or it won't. If it has these two slashes, it's not paying any dividends. It's your choice. You can buy or sell based upon the value or the potential value. But if it has dividends, you can buy or sell. You can make money because the value increases and because of the dividend pays out. Most of the time, you'll see a dividend of like 25 cents per quarter, or you'll see it says a dividend of $1 per year. Essentially, these two things are the same thing. What that means is for every stock you have, for every one share you have, every quarter, the company you own as an owner will give you 25 cents. That means if you have 100 shares of something every quarter, you will get 25 cents. You'll get $25. So you can see that if you own 100 stock, if you had 100 stock of, can they see? Okay. If you had 100 stock of $5 stock, and they paid you a dividend of 25 cents. What's that? 100 times 5. That's 500. You have a value of $500 you put in, right? Every quarter, they give you 25 cents. So every quarter, you're making $25 off your $500 investment. Now, in the long run, you can see how that adds up. So over the course of 1 year, you have your $500 investment and $100 worth of dividend payout. All right? So every year, your $500 is added with your $100, and you have, oh, you can't see that. Let me stop. Let me redo that. So I'll redo it. So you have $100, the investment. I'm sorry. You bought $100 stock. You bought $100 of the $5 stock. That's $500 worth of value of that company. So you put in 100 shares of ownership. Each year or each quarter, that company yields you 25 cents of dividend. So that 25 cents times 100 shares equals $25, right? So now, you multiply that times 4, and that's 4 is 4 quarters in a year, equals 100. So you'll get $100 worth of dividend per year for your $5 stock. And you find out what the dividend is by looking at the stock. You can Google the stock, search the stock, E-Trade, every form, every application, whatever it may be, will give you the dividend yield at the bottom. And when you look at the dividend, I want you to look at two things. You're going to have a DIV date, and you're going to have a payout date. Now, different stock formats display this differently, so I won't put it in stone how they display it, but you'll have it may say dividend yield date, dividend payout date, whatever the date may be. Long story short, what you're going to do is the dividend date is is the date you own the stock. So if you own that stock on that date, you're going to get this dividend. And then the yield date or the pay date is the day they actually give you the money. If you have one of these brokerage accounts, you can, you basically at the end of the day, it'll put it back into your money, and again, it'll end up yielding you money. So you can see how having $100 here per $5 stock per $5 investment can yield you $600 in the future. Your original $500 plus your $100. So within a year, your ownership in that in that company has basically increased a fifth. So now your ownership in the company is a $600 value. It's grown by 20%. So as an investor, you put $500 and got a 20% investment from the year. That's great. Now the dividend does not count your increase in stock value. So you can have your dividend payout 25 cents, plus if your stock value increases, now you're starting to really make a lot of money. And some companies, in some stock markets, if you buy stock over $5, they'll allow you to take this $100 and invest it and buy more of the $5 stock. So you end up getting 20 more stock for the $5. So instead of cashing it out, you can cash it out, or you can do what is called a buyback. And essentially what that does is reinvestment, It takes this $100 you would have made buys more stock at whatever the value is, the market value. Now, instead of having 100 stock that you began with, you now end up with 120 stocks or 120 shares of that company. And it's still at a value of $5. And that's how you increase your value and your ownership in the company, and your shares of the value of the stock may go up. Hope that makes sense. Trying to do this and make this make sense a simple way. But this is how long-term investors, they make their money. Now, just imagine that happening over years. Over years, the stocks are basically buying itself. The company gives you a dividend. It pays itself. It buys more shares. As the value increases, it gives more dividends. The stronger the company, the more dividends, the more it increases. So, and that's how you get, all of a sudden, you may have started out with 100 shares like this, or $100 worth of X amount of company, and then you turn around and you have 300 shares of a company. Your increase in value shares. Go ahead, Tiffany, if you have a question, ask. But this is, just the basics of stocks. Again, I want to get in, I want to get out. Now, I did have a question. Somebody asked me, how do you buy bankrupt stock? Because I mentioned that the other day, that I'm buying into JCPenney's, or I'm buying into, like Hertz just went bankrupt, right? Somebody asked, how do you buy bankrupt stock? You don't want to buy bankrupt stock. You want to buy stocks from companies that went into bankruptcy. All right, big difference. If it's bankrupt, it's done. Most companies that you hear, there are a lot of different chapters of bankruptcy, but you want to go, companies that go into chapter 7, you're screwed. Money, kapoosh. Stay away, run away, your money is gone. Companies that go into chapter, is it 11 or 13 or something? I think it's 11. But anyway, basically what you want to look for is the term. You don't know what chapter it is, and I probably not knowing what chapter it is. You want to look for restructure, or you want to hear them say that they're restructuring their debt. Right? And what does it mean to restructure their debt? That means, in theory, they're trying to stay in business. And if they're trying to stay in business, then you can buy and sell stock. Why? Because somebody else is willing to buy and share that stock. So a stock is only as good as somebody's willing to buy it. And if you don't know if somebody's willing to buy that stock, look at a company's volume. Every time you look at a particular stock, when you Google for that day or for previous days, it'll tell you the volume. If the volume is at 0 or 100 or 1,000, what does that tell you? Nobody's buying it. These are not being bought or sold that day. So there's no value. There's very little value, very little risk in that stock. Very little potential profit because nobody's buying that stock. But you'll still have some companies in bankruptcy that have values of, millions. They can still have 10 million. That means there are people on the market. Okay. There are people on the market. So hold on. For some of this stuff, we're going to have to end the video and then start it back, because like on my Instagram, it's on a certain time. But for the rest of you guys, we're going to keep going. But I'm going to wrap it up because it's been an hour. And I don't know if anybody cares, but for those that care, It'll still be on for those that don't care. Just listen up. Because again, this is just the basics. I know it's a lot. But if you're scared of a company in bankruptcy, again, look at the volume because this will tell you if investors think that there's some money into it. Now, a lot of times when companies are in bankruptcy, their stock will drop below $1. For the most part, it's not always true. I bought PCG or PGC or something like that. Whatever that company started the fires in California. PGC. I bought that company in bankruptcy and I made a lot of money in it because I knew that they were too big to fail and America was corrupt. So I figured they won't let this company go under. So I bought it when it was low. It went up, $10 and, got in, cashed out, made, a few dollars. All right. But sometimes a company may go, you may buy a company and you look at it, bankruptcy and it's like 11 cents. Does that mean that the stock is worthless? No. If you look at the volume like I showed you, that means it's heavy buying and selling. So think about this. I'm going to say this. Let's say a company goes 10 cents. And if it's at 10 cents and I go in and I buy, what's the calculator? And I put in, again, I'm just doing my thing, my $100. Now, that is 1,000 stock. No. That 1,000? Oh, I'm sorry. It's pointing. I knew something was off. No, I'm sorry. It's not 1,000 stock. Yeah, I think it is. Well, anything. Let's say 10. Yeah, 10 cents. Yeah, I think it's 1,000 stock. What are we doing? Hold on for a second. So we have 1,000 stocks. So I have 10 cents. I have $1,000. I'm sorry, 10 cents. I have $100. I'm gonna buy 1,000 stock. All right. So what does that mean? That means if this stock goes up to 20 cents and my $100 gets me, sorry, if this 20 cents of the 1,000 stock goes up, the stock goes from 10 to 20 cents, now I can have 2,000 stock. I'm sorry. I can have $200. Sorry. Now this 1,000 stock goes up to 50 cents of my 1,000 stock that I got. I can make $500. All right. Now, all of this from a bankrupt stock, again, I don't have any money, so I'm broke. But I want to get in. I don't want to have that much risk, and I'm only willing to put in a few dollars. So, 50 cents, I put in a little bit of money in this bankrupt company. It went from 10 cents to 50 cents. I only bought 1,000 shares of this small stock, and then now I made $400. That's how you get into the market. Small, low risk, and you can play with it. If you lose it, if you're 10 cent, as soon as you put in the 10 cent, and then you hear the news and say, well, that's it, shareholders get nothing. Your $100. So if you so if you put in the 10 cents, if you buy $100 worth of 10-cent stock, and the bankruptcy judge say shareholders get nothing, debt collectors get everything, you basically screwed out your money and you went broke. But did you really go broke? No, because you invested in diversified. So one of your $100 is screwed. You're going. But this can happen. That's the term bankruptcy. So this is a risk. Remember, when I started, you can and will lose money. You don't know which one of these will go up. You don't know which one of these will go down. But you know that you have the opportunity. Now, also, sometimes what happens sometimes what happens in bankruptcy, companies will what they call emerge from bankruptcy. And if they emerge from bankruptcy and you bought the stock at $10, you bought 1,000 shares, sometimes what they'll do is reorganize your shares, and then when they emerge from bankruptcy, they'll just give you part of the new company at probably a greater value. And that's the risk you take. And if it worked, it works. So sometimes you gain money like this, you buy and sell like this. This is trading. That's in and out, in and out, in and out. I personally do not like to wait for companies to get out of bankruptcy before I spend my money, before I sell it. I buy it here, I sell it here. Make the money in, get out. Why? Because you never know what's going to happen in bankruptcy. It is a crapshoot. It is a lotto. It's buying a lotto ticket. Sometimes you win, sometimes you lose. The biggest companies, no matter how big, with their really corrupt companies, will probably emerge out of bankruptcy. But some companies will be so big that they'll take your money and you just put all the money in and you're screwed. So again, this is what the market, that means this is what the market bears. You look at the volume to see if people are buying and selling, to see if it's worth it. The debt of the company, if traders do not believe that there's value into it, then they won't put anything in the market. I remember I bought one company and it was at 10%, and it was zinc at the time, and it was selling zinc at the time. And at the time, zinc was really, really low. The market was low. I don't know what happened, but they ended up going into bankruptcy because everything, the cost of zinc was just so low. But while in bankruptcy, the value of zinc, for some reason, something was happening in the marketplace, just shot up. Well, guess what? This company in bankruptcy had a whole bunch of zinc in their hands. So what they did in bankruptcy, they started to sell off the zinc. They said that they were not going to emerge from bankruptcy. Well, they didn't know if they were going to emerge, but the cost of zinc started to go up. So my value went from 10 cents to $1. So it went from 10 cents to $1. So you know what I did? Let's just take this thing. My $100 brought me $1,000. Just that simple. Got in, got out. Bought a company for 10 cents, $100, made $1,000 off of it. That's what I did in the beginning. I bought, sold, and I risked everything. But I'm a risk taker. If you know me in person, that's what I do. Those are the basics. So I'm going to end here. It's been an hour. I'll try to do another video later based on the questions that people asked me to do. This is really informal because I just put up the post the other day and people were inboxing me so much. They had a lot of questions. Again, this is for beginners. If you're really into a lot of trading, this is not for you. This is for somebody who had Who wants to know to begin with? Oh, I'm sorry. Before I end this, I'm going to talk about bonds really quickly in like 5 minutes. So, just in case somebody wants to get into that. My board is all messed up. So bonds are a little bit quicker. Real simple. Stocks, again, you buy, sell stocks. Bonds, you're loaning somebody money. What does that mean? That means, again, treasury bonds, when you hear that term, bond market, anything like that, sometimes that means that you have $100. A bond company they're looking for a lot of people to invest in, let's just say, a 5-year bond. Make it real simple. So your $100, you're going to buy it, and and the interest rate is 5%, right? So what happens with a bond is you're loaning money to a company or city or government of whatever type, right? You're loaning some money to whatever type for 5% annual interest rate. So each year, you will give them your money. You've given them the $100 for the year. So they're basically like, you own a company, you want somebody to invest in you. These governments, big corporations say, hey, give us a bond. And you're going to give them that bond so you can get 5% each year. So every year out of the $100, you essentially get 5% back, or $5, right? Now, obviously, this is happening in the thousands. You got real money. So you get $5 back to you. Year 1. Year 2, same thing. Year 3, year 4, year 5. 1, 2, 3, 4, 5. So $5 comes back to you. So essentially, you've made $25, right? This is why they call bonds more secure. It's not secure as in the guarantee. It's just more secure as in less risky as stocks, because they go up and down. Bonds are essentially a contract, like the bank loans you money and they get their interest. It's the same thing. You're loaning somebody else money and you want your interest. In this case, I say 5%, but it could be whatever the percentage that they're asking for. So if you see a good yield, if you see a bad yield, stay away. Long story short, at the end of those 5 years, year 1, year 2, year 3, year 4, year 5, they give you back your $100, and then you get your $25. And then that's how you make money in bonds. You become the loaner or lender of money. And that's really it. Multiply that times thousands, 100,000s, millions, and you've got a lot of rich folks. And that's it. That's my class for today. Thank you, everybody.